Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hey everybody, welcome back to another episode of the DIY Wealth Canada podcast. I'm Bob, along with me is Nelson, my co-host. Today we got a fun one. We're going to talk about the terrible financial advice that we have received over the years. I certainly have gotten a few ones, which always got me a little bit dumbfounded when I hear them. I'm sure, Nelson, you have a few, so why don't we start with you?
Sure. So I'm going to start with a story that happened probably, let's say 15 years ago. It was a while ago anyway. And I was working in a job that shall remain nameless and unidentified, but it was a commission-based job. And my boss one day, he pulls me aside and he says, you know, you're not pulling your weight, et cetera, et cetera. There's some problems here. And his solution to the problem was that I should create a big financial obligation, and then that would give me the incentive to work harder to try to erase this big financial obligation. I needed, kind of a fire under me, he thought, in order to work harder. And the idea of the financial obligation that he wanted me to take on was and remember, this is 15 years ago, he wanted me to buy a car that cost about $50,000 because the payment, which I think would have ended up being like $800 or $900 a month, just a huge amount of money, would create the incentive for me to work hard and to generate more business for both myself and the company. So I think that's got to be the worst piece of financial advice, or whatever you want to call it, because that's certainly not advice. It's just terrible. Anyway, that's the worst piece of financial information that I've ever gotten. And even to this day, it's been 15 years, and I still just can't believe that it was so bad.
Yeah, that's a pretty bad advice for sure. So on I guess one would be, a while ago, my company, where the company I worked for was publicly traded because we got acquired. So many, many years ago, the company stock was doing really well. The price kept going up. And, we were just talking over lunch, and a few coworkers of mine were like, oh, we should just put all of our money into the company stock and kind of ride the way up and cash out, right? Because the company is doing well. Why not take advantage of it and get some money out of it? Why is that a very bad financial advice? Well, one, when you're working at a company, you're getting paid by the company. Your salary, your income is from that company. So you're tied to the company performance. When company's doing well, yeah, sure, it's great and all, but by investing more money into the company share, essentially you're putting all your eggs in one basket, right? So your income comes from there, your investment money is all tied up in the company stock, right? When things are going well, sure, it looks good, you may get rewarded on paper, right? But the question is, one is, when do you sell, right? A lot of people don't and can't time sell their investment quite that well, myself included most of the time. Two is that when you're getting paid by a company and, when company is doing well, great. But what happens if all of a sudden the company is doing poorly, right? The stock price typically trails a little bit compared to the company performance, right? A company could see bad times ahead of their earnings, so they typically cut employees or, lay off people ahead of these bad announcements. So what if you got laid off and, all your money is tied to the company stock? That's a bit of a double whammy. So that's probably one of the worst financial advices I have received. Just don't put your eggs in one basket, I would say.
For people who don't know, I'm in Alberta oil country, especially in northern Alberta. It's a big driver of the economy up here. And what you'll see in Alberta, especially, is you'll see guys who work for an oil company who live in a town that is strongly driven by oil, the local economy, and then they'll take their investment dollars or their retirement fund or whatever, and they'll put that money back into oil stocks because that's what they know, and they think that they have some sort of edge there. And of course, the performance of oil stocks has a lot to do with the price of oil. It doesn't have everything to do with the price of oil, but that's certainly the biggest factor that factors into that. So that lack of diversification, whether it's your company stock, whether it's your even like the sector that your company is in, I would really, really urge people to, take that terrible piece of advice that you got and kind of think about maybe taking it one step further and just remembering that when it comes to portfolio diversification, the place that you work is always going to have a much bigger impact than perhaps it would normally on your net worth. Now, saying that, Bob, I wanted to ask you, putting all of your money in your employer's stock is a bad idea, but I think putting some of your employers or some of your money in your employer's stock is generally not such a bad idea because very often you get a discount for buying those shares. So how would you consider, kind of those factors when purchasing company stock? Like how much of your net worth or portfolio would you be comfortable in, and kind of what steps would you take to make sure that it doesn't get too big?
Yeah, that's a very good question. I certainly know people that work for Tesla or Nvidia that have done really, really well. And yeah, a lot of their compensations tie into their company stocks. It kind of depends, right? So some companies offer, I guess it's called stock share purchasing program. So essentially each paycheck you could put 10% or whatever percent of your pay toward buying company stock. The stock price typically is like an average of certain times, or maybe like an average price of 20 days or 30 days. And then typically with these programs, what happens is company would contribute say 10 or 15 or 20% of your contribution up to a certain amount of money, right? So when you do that, first of all, you're kind of getting a discount of the share price, and two, you're getting free money from your employer. So almost always it makes sense to do this program, right? To participate in this program and just take advantage of the free money essentially and try to get the good returns. So that's one. Like my company, my employer used to do that a very, very long time ago. When I started, they stopped doing it after a few years. And what typically, and then so that's one option. Two would be a company could provide you with stock options. So how stock options will work would be, say, when you join the company stock is at $30 a share. They would tell you, okay, we will give you stock option $30 a share for, I don't know, 1,000 shares, and you could exercise these option every year at a certain date. Those work when the company price keeps going up, right? So you can imagine with Nvidia, Apple, Google, the stock price keeps going up. So when your options are $30 and the company stock is at, $100, you're making a lot of gains. And typically with option, you have to buy them first before you can sell. So you need to have some certain amount of money set aside in order to exercise those options. The third option is probably the most common, is called restricted stock units, RSUs. So essentially the company would give you, say, $10,000 worth of stocks, and a third of it get vested every year, right? And then say they give you $10,000 and your stock price is at $10 and you just get X number of shares. And then every year on the vested day, you get the share essentially convert into real shares, and typically half of that goes into taxes, and you get half of that in shares. And then once it's vested, you could decide whether to sell or not. So that's the third way companies could give you some shares. And to answer your question, Nelson, it really depends how comfortable you are with investing in your company. If your compensation is tied to the RSUs, maybe you don't really buy too many shares outside the RSUs. If you have stock options, those are kind of tricky because unless the company stocks keeps going up, the options could get worthless, right? So imagine you join the company during the dot-com bubble where a lot of these internet stocks are overvalued. So imagine you join a company and their company stocks at $200 a share. And then a few years later, the dot-com bubble happened and the share price drops to $10 a share. It doesn't make sense to exercise your options anymore, right? Because your options are $200 a share. Now the stock price is $10 a share. For you to opt to exercise the options, you will actually lose money. So essentially your options are worthless. So it really depends. In my personal scenario, I don't personally invest in my company stocks outside of the company compensation because I don't want to tie up to myself to the performance of the company, right? So, but some people put a little bit. I would say maybe up to 10 to 20% is okay. I wouldn't put more than that.
Yeah, I would go a little bit less aggressive than that. Saying what you said about the RSUs and all those various programs, which is great information. At the end of the day, you should take free money if your company is giving you free money. So in terms of either an RSU, a discount on whatever it is, that is a good thing to have. Like if you're getting a 20% discount on shares, you're essentially getting a 20% risk-free return immediately, and that's a good thing. But saying that, what that becomes a bad thing is when you end up with too much of your portfolio in your company's stock, and then the company struggles, whatever happens. So I would say that for me personally, I would not be comfortable going much more over like the 5 to 10% level in terms of my net worth in my company, just because I want to make sure that if the company goes under or the company struggles, usually companies that are big enough to be on the stock exchange don't go under, but they will struggle sometimes, that I minimize my risk. And that might mean some sort of plan that I come up with beforehand where I say, okay, like if the stock does this, I'm going to sell some, whether it hits a 52-week high, whether it trades at an elevated price to earnings ratio, kind of whatever the strategy is, I would make sure that I stuck with that over time. And I think the key to a strategy like that is coming up with it when you're feeling sober, when you're not excited, and to just follow the rule no matter what. So if you're going to be cautious, because the time when you're not going to be cautious is when the stock is flying, and then maybe a year or two later you might regret not selling. It's especially important when you're thinking about your company stock, and I would be cautious. Normally I'm really not a fan of selling. I think people screw up the selling decisions a lot, but in this case I would be extra cautious.
Another thing to add is it also depends on how much your compensation is tied to the stock, right? Like either the RSU or options. If you're getting RSUs and your total compensation, like the RSU takes out say 20 or 30%. Like as you go up the corporate ladder, your compensation goes higher. So it depends on how big of a compensation is tied to the RSU. And then the other thing to consider is, like for myself, I'm in my company's blackout window. So really there's only 4 months out of the year I could sell. So that really restrict how flexible I can be with these RSUs, right? So when you're tied to being able to sell 4 months out of the year, it's most likely better to just sell whenever your shares are vested, just so you just have some money on your hands and you're not tied to the blackout window. So there are a few things to consider when you get compensated via company stocks.
Great. I'm going to talk another piece of terrible financial advice that I got. And this one came from a financial advisor who I don't even remember his name anymore, actually. I know his face, but I don't know his name. So this is a while ago. And what this financial advisor told me was that picking and choosing my own investments was a terrible idea. I didn't know what I was doing. This was after we met at a party. We had a 5 to 10 minute discussion about stocks. He did not like my dividend boring approach. And at the end of the conversation, he told me that I shouldn't bother and that I should invest my money with him. And I said, well, what funds would you suggest? Like, how would you invest my money for me? And he rattled off a couple of mutual funds that he thought were fantastic. And after the party, I went home and I looked them up, and each of them had a 2% plus MER, management expense ratio, on those. And I was just flabbergasted that this person thought that these funds with a very obvious fee drag, which, by the way, were investing in the same kind of stocks that I was investing in myself, that fund was a good idea versus just investing in those stocks themselves without his guidance. Bob, I know that you've had a bad experience with high fee mutual funds in the past. Have you ever had a advisor specifically tell you that you can't do it on your own?
Not entirely that way. Just I have had a few so-called financial advisors at banks saying, "Oh, they buy these high MER mutual funds themselves, and that should be the way to invest. You shouldn't look anywhere else." So maybe not as extreme as your example, but certainly similar experience.
Yeah, I think that, in terms of using an advisor, not using an advisor, I'm not going to tell anyone what to do. I'm just telling about the experience that I've had. And I'd say for the most part is that the financial advice industry really preys on people. They want to make relatively simple things seem very complex in order for you to need their advice, their help. And of course, in giving that, they charge you some charge a rather large fee, other ones charge a smaller fee. I don't want to throw everybody under the bus here, but I will say generally that, part of the reason why we started this podcast and why it's called, the DIY Wealth Canada podcast is because we think that, at least I think, I don't want to put words in Bob's mouth, but I think he'll agree with me here, is that we think that you can do it on your own and that you don't need to pay a financial advisor for every little thing. You don't need an advisor to have a nice, simple portfolio. Index funds do that for you, or dividend stocks do that for you, or however you'd like to invest. You don't need a advisor to tell you when to take CPP. That's basic common sense. You get less if you take it at 60, you get more if you take it at 70, and you can determine your financial picture well enough to know that, hey, I could use the income at 60, or I should wait until I turn 70. And of course, all these other variables that a advisor will help you with. So that'd be my message in terms of that, is just, look, yes, the world of finance can be a little complicated, but you can figure it out. And there's a community online that will help you.
Yeah, absolutely, Nelson. Having said that, I do think if you have specific topics or questions, it makes sense to do a fees only financial advisor, or find somebody that takes fees only, like charge it hourly or something, right? So for example, if you need some, tax planning, maybe talk to a CPA or tax professional. If you need like estate planning or some sort, then maybe a financial advisor makes sense, right? But I think there are so many resources available on the internet, at libraries. It almost makes sense for you to do it yourself and like DIY and then approach an expert when you need that special advice. So we're kind of going off tangent a little bit, so let's bring it back to the topic. So I think it's my turn. In terms of terrible financial advice, I guess this one is more general. It has to do with just wait until like don't wait until something crashes, right? So one would be, wait till the Vancouver housing market crashes before you buy a house, or wait till the stock market crashes before you invest in the stock market. In theory, that sounds really, really good, but in reality, it doesn't quite work that way, right? Like there's been talks about the Vancouver housing market will crash, for I don't know, 20 years now. It seems to kind of down a little bit, but there's never been like a significant crash, I would say. I haven't seen like, 20, 30, 40% housing crash in the Vancouver housing market. And even in the stock market, people say, "Oh, don't buy until there's a correction." But like you never know when a correction is. Look back, right, during COVID, the pandemic, the stock market certainly crashed, but that was very short-lived. And I don't think anybody would be able to tell you during that crazy time that I think March 20th or March 21st was the lowest of the market. Like, how would anybody predict that, right? And you're better off just continue investing throughout time and be in the market, right? Time in the market rather than time in the market, and dollar cost average and write it out over the long term instead of trying to time yourself. Because timing the market or timing anything, personally, I think it doesn't work. You're going to be too stressed out. You're always second guessing yourself, and you never know, right? So just keep it simple, keep it stupid, stay invested, invest whenever you have money available, and dollar cost average and compound your portfolio over time. I think that's probably the best advice I would give to anybody, rather than saying, "Oh, wait for a crash." That's just a terrible, terrible advice.
I'm confident that the average person who has waited for 15 or 20 years for the Vancouver property market to crash, meanwhile, while houses are up, 50, 75, 100%, whatever they've been up in that time period, probably even more than that. So well, Vancouver real estate is done. I think that person, once the market does actually crash, they will just sit on their hands and they'll say, well, yeah, it's 30% lower, but it's going to go another 30% lower. So I'm going to buy then. Those people always move the goalposts with that kind of stuff. And they seemingly never hit that bottom because it's all an excuse. It's all an excuse to not do it because it's too expensive. They're scared, whatever the reason. In terms of investing at a bottom of the market, I think that you're definitely right, Bob, where it's like, you can't predict when the market's going to crash, so don't bother. But what I will say, what I've done, and this works kind of relatively well for me, is I look at individual sectors in the market as from an active perspective. So, right now, as we record this, the REIT sector in the US and in Canada too, I think there's some bargains there. So even though, we're very close to all-time highs in the S&P 500, TSX, composite, I look at these areas in the market that I see value in, and I concentrate my effort there. So that way it's like I'm buying stuff at a discount, but I'm not hoarding all of this cash waiting for a crash, because that's where the bad part of this decision comes in, is that cash has opportunity costs. And when you don't put it to work, that's a problem. It just sits there and you might miss out on fantastic returns because you're looking for the best buy time. And the best buy time is today. Figure something out. And if you can't figure something out, then just invest it, whether it's an index fund or whatever, because ultimately time in the market, like you said, is the best thing.
Yeah, for sure. And just to add, right, I did say, timing the market doesn't make sense, but you could, just like what Nelson you said, you could look at the sector or even individual stocks. Sometimes when a stock is near 52-week low, and if the company's valuation looks good and you believe in the company long term, it almost always makes sense to invest near 52-week low. What I want to caution people or listeners is that what's bad is when I certainly know people that, for example, they want to invest in, I don't know, say Apple, and they think they don't want to get into Apple until the stock price is at a certain point, right? So say Apple today is, just looking up, Apple today is say $270 a share, and they think that's completely overvalued. So they set a unrealistic target, say $200 a share. That's when they want to start buying Apple shares. But what happens if the Apple share never goes down to 200? You certainly maybe lose an opportunity to invest in Apple. Or even worse, say Apple share price dropped to 201 one day all of a sudden, but your target is 200. Do you not buy until the share price goes to 200, or do you step in and say, okay, I'll buy some at 201? Some people I know will not buy Apple shares until the share price reaches their target, $200. But what if Apple never reaches $200 and it dips down and then it goes back up again? Again, you lose this great opportunity to invest in Apple. Right? So you have to kind of be a little bit careful in terms of when you set a target price to buy certain things. Just be a little cautious in terms of how rigid you are with that price target. Now, I'm not saying don't ignore valuation or things like that, but just don't lose out on opportunity, right? So like Google, for example, in 2025, it was struggling a little bit, right? It went down quite a bit, and people were not convinced about Google or Alphabet as a whole, and people were like, oh, it's going to go down more, and so on and so on. But then it turned around and went up. So if you had set the price target as said, I think the lowest it went down to was about just a little bit below $150 a share. Now, if you had set Google or Alphabet at $100 a share and you didn't want to waver that target, you lose out on a huge opportunity to invest in Google when the share price was down quite a bit. Right? So just be a little bit careful there.
Yeah, definitely. The rigidness of the target price, you're absolutely right. Have some flexibility there, and just remember that you're never going to catch the bottom on anything. So if you buy something and it goes down a little bit, hey, it goes down a little bit. Like, as long as the value is there when you bought, the specific price you paid, I don't think matters nearly as much. Let me pivot into the last piece of the terrible financial advice I wanted to talk about on this show. And I think we might have a bit of a debate about this one, because I've said before about how I don't think this is very good advice, and I get a lot of pushback. So I'm interested to hear what you think, Bob. I think that putting 5% or some small percent of your portfolio into kind of lottery ticket stocks, these companies that just are very different from my long-term investing plan. You're looking for these big gains. I think that's terrible thing to do. And I'll tell you why, from my perspective anyway. My perspective is that capital is precious, and that any capital that I put aside into something that does not get me towards my goals is just a waste of money. Even if it could work out and I might turn that 5% of my money into a much larger part of my money, I don't think it's a good idea, because it takes away from my goals. And ultimately, that's the whole reason why we invest and why we're doing it. So, Bob, what do you think? Is that am I crazy here, or do you see my logic?
No, I definitely see your logic. It makes sense, but I think it depends on what you define as risky investments. Like, for example, in our investment portfolio, I think the rule was 10%, but right now ours is probably less than 5%. So 5% of our overall, less than 5% of our overall portfolio is invested. I call it higher risk companies, but when I say higher risk, I guess it's more higher volatility. So stocks like Amazon, Nvidia, Tesla, like I wouldn't call these high risk compared to so-called penny stocks. Right. So for me, the Tesla, the Amazon, the Nvidia are higher risk, say, than say dividend stocks because they're more volatile. Therefore, you have a bigger swing. The highs are high, lows are lows. Right. So you could, like within one day, I think last week, Nvidia came out with their earnings and the stock jumped quite a bit after market, but then the next day dived down significantly. So I think there was like a 10% swing or something. That's a pretty significant volatility. So that's what I call risky, but maybe some people don't call that as risky, that they think that's relatively safe. So it depends on your definition of risky. But yeah, I think I'm in agreement with you, Nelson. Any capital is important capital. You need to watch out your risk allocation and really watch out for any losses, right? So if you're investing 5% of your portfolio in more risky investments, maybe set limit loss there, just so you don't significantly erode your capital, and really watch out what you pick in terms of stocks. So that's one. So I guess the last terrible investment or terrible financial advice I have received over the year is, when you get a promotion or something, whenever like a salary bump or whatever, then people are like, oh, you deserve to buy something new, like get a new car, get a new shiny toy, get a new gadget. Personally, I think that's a terrible idea and terrible advice, because like, do you really need that shiny new toy? Like, just because your car is a couple of years old doesn't necessarily mean you need a new car. So I was just cautious in terms of getting that kind of advice and thinking that you deserve buying something new just because you got a promotion or a salary adjustment. You could put your money into better use. That's my opinion anyways.
Yeah, for sure. I agree with you there. And I think too, just in general, there are ways to reward yourself that don't cost money or that don't cost a, ongoing obligation. So there's a difference between, like, say, hey, I'm going to go away for the weekend to celebrate my new promotion. Yes, you do spend some money, but you're not spending, like if you buy a car, well, a car is going to cost you extra money each and every month. There's going to be a payment, there's going to be, extra insurance, you might have more gas, etc. So I think that just in general, to think about ways to reward yourself that aren't really money oriented, that are maybe things that don't cost but will give you value in substitute for that. So there's all sorts of ways you could potentially do that. But I think just in general, that's a smart way to go about it.
Absolutely. I think you really need to understand, what drives happiness for you, or joyfulness, right? Like when getting something new, it's exciting, but that happiness is very short-lived based on my personal experience, right? And you end up wanting a bigger item as you get more and more new stuff. So it's a very slippery slope to go down.
Yeah, for sure. It's such a hollow way to, at the end of the day, it's like, well, why do we spend money? And we spend money to either get things that we want to have, to make our family's life more comfortable, or to impress other people. And just in general, impressing other people with money is just, I don't think, a very good way to go about it, because on your deathbed, are you really going to want people to be impressed with your car or your house or whatever? Or do you want them to be impressed because you were kind or funny or were a good person or were helpful, or all these other things that we want? And for me, it's an absolute no-brainer. Like, I don't care what anyone thinks about my finances. What I do care is how they view me. And spending on that is just, in my opinion, just such a poor way to try to get that self-respect.
Yeah, I think we're just up against time here. And that you brought up something very interesting. For me, years ago, I went to a retirement party of a high school teacher of mine that has affected me like positively over the years, right? And then, one of the speeches that somebody gave during the retirement party was, and that this quote really made me think a lot, is that, I'm paraphrasing here, and the quote is, at the end of the day, it doesn't really matter how much money you have in your bank account. What matters is how many people's lives you have influenced, and how many people think about you positively when they consider your name. So, think about that statement, right? It's not about what you have or how much money you have in your bank account. It's how the impact you have had on other people around you. I think that's the most important things in life. And I'll just leave it at that.
It's actually a fantastic way to end this episode. I think it was a somewhat of a negative where we talk about, bad financial advice that we've gotten, and we're going to end it with a really nice positive quote, because that's a very nice way to end it. So anyway, everyone, thanks for listening. Bob and I always appreciate it. Make sure you subscribe, you leave us a comment, please, or interact with us on Twitter. You can find Bob at Talkan, and I'm at CDI Newsletter. We really appreciate everyone listening, and we'll see you next time.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Talkan or CDI Newsletter. Thanks. See you next time.